The UK is quietly flipping the switch on crypto. This isn't some incremental tweak, it's the country's biggest regulation yet. And it starts today. The Bank of England and the Financial Conduct Authority plan to publish their stablecoin consultation. It will roll out new rules for digital payments, reserve-backed assets, and oversight that's been brewing far longer than you realize. Yes, proposed limits of $20,000 per individual and $10 million per business. Funds and firms will face tighter supervision. Payment providers and fintechs will be under the microscope. And it's happening at the same time as the US races ahead with its own framework. The timing isn't accidental. For years, crypto regulation in the UK has felt like watching from the passenger seat. Meanwhile, firms built tech, coins printed, hype roared. But the seat belt was never clicked. Now, that belt is about to lock. The context matters. The US passed the Genius Act earlier this year. Now, the UK is positioning itself not to lag. These aren't theoretical rules. They will define who controls, who pays, and what coins will be usable in mainstream finance. The framework will cover stablecoins that become widely used for payments. If a coin sits in that systemic bucket, the Bank of England steps in. Other coins will fall under the FCA under lighter rules. This distinction is crucial because many coins currently trade freely. If you're in the systemic class, your issuer will face bank-level oversight. This is the headline grabber. The UK may impose $20,000 caps for individuals and $10 million caps for businesses on stablecoin holdings. Why? Because regulators fear a mass migration of deposits offshore into coins that banks can't lend against. A flight risk. So while you've been thinking about moonshots, these rules are about who controls the pool. Expect a cooperation model. BOE plus FCA will share oversight depending on classification. This means stablecoin issuers will face bank-style regulation in one regime and asset regulator style in another. For fintech firms and token issuers, this isn't just a rule change. It's a structural shift in how they'll be authorized, funded, and challenged. The UK isn't making its rules in isolation. The aim is to synchronize with the US regulation. That brings cross-border capital flows, crypto firms, and regulatory leverage into play. Why this matters? If the UK and US align, coins and firms will have to operate under an Atlantic standard, which means your coins, your apps, your flows could face identical expectations in London and New York. If you hold coins that might be deemed systemic, you could face new usage restrictions. How much coin you can hold, how you trade it. If you trade stablecoins for payments or remittances, issuers may need full reserve backing, liquidity access, and restrictions on who can participate. If you're using fintech apps, expect tighter onboarding, identity verification, transaction limits, and possibly slower flows. Big picture. Coins might shift from decentralized hope to permissioned utility. Which ones? The ones that align with regulation. Why am I talking about UK stablecoins here on an XRP-focused channel? Because the same rails that stablecoins ride are where XRP can play. As the UK regulates stablecoins, coin issuers will seek liquid settlement, cross-border ramps, and regulatory-approved infrastructure. XRP offers interoperable rails, and firms are already laying down those tracks. So while you watch UK regulators draw the lines, you're also watching the rails get built. Novi 10, 2025, consultation paper published. Over subsequent weeks, public comments, industry pushback, amendments. By end 2026, early 2027, rules expected to be operational. Tracking the timing matters because coins, token services, and platforms will adjust before full rules drop. If you hear a coin relabel its issuer or a platform shifting jurisdictions, that's signal, not noise. Mentions of systemic stablecoins in new papers. That tells you coin classification. Disclosures of holding caps or transaction limits in issuers' documentation. Cross-Atlantic regulatory announcements linking UK and US frameworks. Fintech apps adjusting payout models in the UK and Europe. Their copy will shift. XRP or other token-enabled platforms being referenced for settlement or liquidity. This rules cycle creates demand for infrastructure. This isn't about hype, it's about power. Because when a coin or token transitions from speculation to permissioned infrastructure, the world changes. Not because of the coin's price, but because of its function. And when regulators set the rules, they're often not writing new lines. They're setting who controls the rails. So market, November 10th, 2025, the UK initiates the next era of digital asset regulation. Whether you trade, hold, or analyze, the playing field is evolving. When rules drop, coins will matter less than what they're used for. And as we watch stablecoin rules, we're also watching the rails get built under the surface. Because sometime soon, the coin you hold won't just be about winning, it'll be about working. And when that shift happens, the ones ahead won't ask for charts. They'll ask for access.